The stock market has been buzzing lately. There has been a lot of attention on certain stocks that have just been performing exceptionally well, which have managed to prop up the entire market too. If you are familiar with acronyms like FANG or MAMA, then you are most likely familiar with what is now known as the Magnificent Seven, which are a big reason for this meteoric rise which we have been witnessing. They are also the reason why people are wondering if it's too late to try and get in and get a piece of the pie, and how anyone can know beforehand that such and such a stock has the potential to perform well so they can buy before the price shoots up. Welcome to the Eighth Wonder, a channel dedicated to making compound interest your best interest. In case you're wondering, the Magnificent Seven refers to, depending on the day, the top 7 US companies by market cap, being Microsoft, Apple, Amazon, Google parent company Alphabet, Tesla, Nvidia, and Meta Platforms, formerly known as Facebook. These companies make up 24% of the total weight of the S&P 500 index, which means that they have quite a lot of influence on how the market behaves. The biggest contributor to the massive growth of the 7 stocks has been Nvidia, which has managed to grow over 200% in about a year, mostly due to the AI boom. The company is perfectly placed so it can cater to all the needs that come with artificial intelligence and make the most of the situation. The other 6 companies are also doing quite well, but nothing like Nvidia is currently doing. There is, however, a common link between them, which is the fact that they are tech companies, and one way or another, they also benefit from the new age of artificial intelligence. If you're wondering why I'm telling you about these stocks and not telling you to just invest in an index fund that holds all of them, then listen up. The truth is, as simple as investing long-term into an index fund is, it doesn't hurt to have some good performing individual stocks to help boost your portfolio. This, however, will require some work on your part in order to reap the benefits. The examples used here are by no means stock picks or recommendations, but simply good examples of the principles that apply. I will also be drawing wisdom from some of the greatest investors around, so you know these are going to be some tried and tested methods. The first point is Peter Lynch's most famous teaching.
Buy what you know is what Peter taught us.
Let's hear what he has to say on this subject.
You have an edge. You might be in that industry where things are starting to improve. When companies go from crappy to semi-crappy, the stock goes up. When it goes from semi-crappy to good, they go up. When business gets to be terrific, get out. You're really got to be careful. Look at the company, look at the balance sheet. What is the reason the stock should be higher? The sucker's going up is not a good reason. Well, I think looking for something different, looking for something that's a good story. I mean, who would have guessed TJX, a local company, would have gone up 50-fold, or Stop and Shop would go up 10-fold, or Analog Devices, or Nvidia. I couldn't pronounce Nvidia. So you have to find a company that's either a turnaround or a company that's going to grow, like Panera or, Family Dollar stores. I'm not saying that buys now, but that's what's made our, Sears is rolled over. So Kmart's rolled over, IBM slowed down. But we've had new companies come along. I mean, that's the nature. You have to be looking for new companies and look at the balance sheet. If you can add 5 and 5 and get reasonably close to 10, you should be able to look at a balance sheet and say, here's 2 depressed companies. They've gone from 50 to 3. One company's got $3 million in cash and no debt. One's got $3 million in debt, no cash. Which one are you going to buy? I mean, that's not too hard to do.
Peter Lynch said a lot in that clip, which is from earlier this year. He first speaks about the advantage of being in an industry. This is an advantage because as one who has some exposure to some of the inner workings, you can see certain developments before everyone else. A very good example of this is something that is very recent. That would be the hype over the weight loss pills Wegovy, or should I say Ozempic, which have caused the stock of the company producing it, Novo Nordisk, to skyrocket. If you are in the pharmaceutical space and early onto the scene, you would have had the advantage of the first mover, which would have made you a significant chunk of change. He also spoke of investing in a business where things are improving. That's where you are most likely to make your money. He mentioned a bunch of companies, including Nvidia, one of the Magnificent Seven companies, which goes to show that the company has benefited a lot from the trends that have taken place due to it being a tech company in the computing and processing space, being involved in the use of microchips, and meeting the needs of the modern world. In all honesty, tech companies have been the most interesting place to invest in with all the new developments that they have brought along with them. This, however, does not mean that you should only look to invest in the tech space. Buying what you know can serve you well in any industry that you understand well enough. The main points that I took from that was that one needs to look for companies that have a good story, turnaround companies. Once you found them, look at their balance sheets and determine if they are investable. You can usually tell this by their debt to income ratio. As Peter Lynch said, a company with cash and no debt is always going to be better advantaged than a company with no cash and lots of debt. This information you'll find on a company's balance sheet, which is public information and can be found with a quick Google search, just like a 13F filing, which you can learn more about in the video I recently made on Michael Berry, which will be linked in the description. So just so you know, all public companies are required by law to make available almost all the information you can ever need in order to make a proper analysis on whether or not a certain stock is a good buy. The next point is to know your circle of competence. One of Warren Buffett's most famous teachings is that about knowing your circle of competence. But what does that even mean? Well, here's Warren Buffett explaining the concept.
Ted Williams wrote a book called The Science of Hitting, and in it he had a picture of himself with bat and the strike zone broken into, I think, 77 squares. And he said if he waited for the pitch that was really in his sweet spot, he would bat 400, and if he had to swing at something on the lower corner, he would probably bat 235. And in investing, I'm in a no-called strike business, which is the best business you can be in. I can look at 1,000 different companies, and I don't have to be right on every one of them or even 50 of them. So I can pick the ball I want to hit. And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle. Defining what your game is, where you're going to have an edge, is enormously important.
What Mr. Buffett is telling us is that it is impossible to understand each and every business out there. But there are certain ones that you will understand very well, and those are the ones that you should be putting a lot of effort into because your understanding gives you an advantage. Just because I started off this video talking about the Magnificent Seven doesn't mean that that is what you should be looking into. In fact, Warren Buffett himself has talked about how he doesn't understand tech businesses much, which is why he doesn't buy into them. The decision to buy Apple most likely came from Ted and Todd, his understudies. Sticking with Warren Buffett, another important lesson from him is understanding the difference between fair value and fair price.
Buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business. And I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it. And 20 years later, I was still running a lousy business. And that money did not compound. You really want to be in a wonderful business because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit.
So in his story, Mr. Buffett explains how he bought Berkshire at a fair price, meaning it was cheap, but it wasn't at fair value, because he couldn't get much out of the existing business and had to change it into his holding company with all the new businesses under it, which is what made it valuable. This, however, cost him a good amount of money, whether it shows up on paper or not. The opportunity cost that going the route that he did is quite big. In order to determine if a company is trading at fair value, you need to know its intrinsic value. Here's Warren Buffett again explaining the concept.
If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. Well, intrinsic value is what is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when?
The concept of intrinsic value can be a bit tricky to understand, but essentially, it means what the company is actually worth when taking future cash flows into consideration. It is essentially like an appraisal of a business to determine if it is actually worth the price it is currently trading at. There is a huge difference between what the company is worth, its intrinsic value, and what it is trading at, its market value. The market value is what people are willing to pay, while the intrinsic value is what it is actually worth. If you can find a good performing company that is trading below its intrinsic value, then you are sitting on a gold mine because it will essentially pay itself back over time. So since I spoke about the Magnificent Seven, let's look at how well they have done recently. As mentioned earlier, Nvidia has been leading the charges. If you look at its share price, you'll notice how between 2020 and 2022, there's been a steady rise, which came mostly from the effects of COVID, with a higher demand for processors and lower supply of semiconductors that are needed to make them. There was a cool-off for a while until the rise of artificial intelligence came along, which was spearheaded by ChatGPT. Speaking of ChatGPT, Microsoft invested $10 billion into OpenAI, the company that brought us ChatGPT. So as you see, from January of this year, when the investment was made, the stock has picked up quite a bit. Apple has been doing very well for quite some time now, especially since 2020. They have taken advantage of their position in the tech world, which saw the company become the first to reach a $3 billion market cap valuation. Amazon saw a huge boost through COVID, with most stores being closed down, and through all of its other services, most notably their web services. Its share price did fall for a bit, but seems to be benefiting from the AI boom too. Alphabet, or Google, also benefited from COVID, then slowed down for a bit. They are one of the companies that are competing in the world of artificial intelligence with their chatbot Bard. They have seen a boost in their share price due to AI too. Tesla is an interesting one. With the meteoric rise it had from 2020 to all the stories surrounding Elon Musk, its CEO, It has been up and down, but has also been benefiting from the AI boom, especially with all the work on autonomous driving, which is an AI function. And Meta has been clawing its way back since the unraveling that took place with the introduction of the metaverse. It has since risen in value too. As you can see, these 7 stocks have been doing great lately, and being invested in any of them at the right time would have yielded great results. That being said, by applying the principles taught by Peter Lynch and Warren Buffett, you can find the next big thing and ride the wave up. With the Magnificent 7 doing so well, the S&P 500 is doing quite well too. In fact, it's looking like it will hit a new all-time high soon. So if you're up to the task of calculating intrinsic values and all that jazz, then there's always that to invest in. What are your thoughts on the Magnificent 7 and the AI boom? Are you taking a lot of interest in them? Comment below and let me know. I hope that you found this video to be magnificent and that you'll indicate that you did by smashing the like button, just like these companies have been smashing brackets. Do share the video with a friend and make sure to subscribe to the channel if you haven't done so already. While you're at it, click the notification bell to stay up to date with the world of finance and investing. Thanks for watching, hope to see you on the next one, but until then, stay invested.